What's good? This King Count Booth, 100 proof, bringing you nothing but the truth. I'm back on, starting off the day here with this property and casualty insurance license exam manual. We left off with a quick quiz 1A. We're diving into 1.5 today. Other insurance concepts. Listen up. King Count Booth, 100 proof, bringing you nothing but the truth. The law of large numbers. The law of large numbers is the principle that makes insurance possible. The larger the group, the more accurately losses can be predicted, though. Insurance companies cover millions of people and businesses. It is impossible to guess specifically who will suffer a loss in the future, but thanks to the law of large numbers, insurance companies can fairly certain how many losses will occur in a group as a whole. While insurance companies cannot specifically name which individuals will have a loss each year, they can predict fairly accurately how many dollars in claims they will have to pay out each year based on the actual losses they experienced in the past. This prediction allows them to change each insurer, and premium that's pooled together will cover all claims and operating costs. Law of large numbers, law of large numbers, law of large numbers, law of groups. The more accurately losses can be predicted. Elements of insurable risk. Not all risks are insurable. Pure risk have certain characteristics and can be remembered by using acronyms. CANHAM. Calculatable premiums must be calculable based upon prior loss statistics for that particular risk in order to predict future losses. Affordable. The premium for transferring the risk should be affordable for average consumer. Non-catastrophic. The risk must be non-catastrophic for the insurance company. Nationals or area disasters such as floods, riots, wars, and earthquakes, will often have coverage limitations in insurance policies. These events cause widespread simultaneous losses to many insurance properties. The peril of war is excluded from the most policies. If the insurer were to cover these types of risks, the risk could be detrimental or catastrophic to the insurer. Homogeneous. The risk should be similar in nature so that the same factors affect the chance of loss. For example, if the actuary was going to predict the likelihood that wood frame houses would suffer a fire in California, the actuary would not include brick houses in the sample. Accidental. The loss has much been caused due to the chance accidents. Intentional loss due because by the insurer or caused by the insurer, not covered by the insurance. Measurable. A definite time and place. The measurable loss means the proof of loss must be established with numbers and dollar amounts, not just casual references. This is called CANHAM. Calculable, affordable, non-catastrophic, homogeneous, accidental, measurable. CANHAM, calculable, affordable, non-catastrophic, homogeneous, accidental, measuramental. Adverse selection. Adverse selection is the tendency for higher risk individuals to keep insurance and compared to individuals that represent an average level of risk. The statistics insurers use to predict their losses are based on average risk. These insurers' adverse selection is a bad thing because it causes more losses than predicted. Therefore, the premiums collected may be enough and could cause the insurance company to lose money. These to avoid adverse selections, insurers make extensive evaluations of information related to the particular risk. A process called underwriting like this. If an underwriter determines that the risk is higher than average, the insurer may charge a higher rate. To ensure the risk limited in amount, the coverage will ensure that the risk is refused in the application, and insurers all gather. Adverse selection, danger, do not enter, warning, high risks. Adverse selection, risk that has greater than adverse average chance of loss, not warranted by insurer. Tendency for high risk individuals to keep insurance. Why insurers go through the underwriting process. High risk, higher rates, and insurance refusal. Reinsurance. Reinsurance is like insurers for insurers. It transfers risk from the other insurer to another insurer to reduce the total amount of loss it is liable for. One insurer may pay the other insurer a premium to assume a portion of the risk. The company reducing its risk is called the cede insurer. The company assuming the risk is called the reinsurer. For example, reinsurers risk certain geographical areas like this may expose the reinsurer to the potential of having to pay for many losses at one time. This may happen due to such things as earthquakes or hurricanes. To protect the company from these catastrophic losses, the insurer pays the premiums to other insurers to transfer some of this risk in these areas. There are two ways the process can work. The reinsurer considers each risk before allowing the transfer from the ceding company. This is called facultative reinsurance. The reinsurer accepts all risks of the certain type from the ceding company. This is called treaty reinsurance. Reinsurance is insurance companies. You see, reinsurance helps insurers spread the risk. Types of insurance. Stock insurers. A stock insurer is a business formed as a corporation and owned by its stockholders, as known as shareholders. The corporation is ran by a board of directors elected by the stockholders. Profits from the insurance operations may be distributed to the stockholders as dividends. These dividends are taxable to the stockholders, shareholders. Dividends are never guaranteed because profits can be guaranteed. These policies issued by stock insurers are called non-participating or non-par policies, since dividends never go to policyholders in this arrangement. Stock insurers, stockholders, stock shareholders, stock issuers owned by stockholders. Dividends are not guaranteed. Dividends are paid to stockholders. Dividends is taxable to stockholders. Insurance non-participating policies. Mutual insurers. A mutual insurer does not have a stock or a stockholder. It is owned by its policyholders, customers, also known as policy owners. Mutual insurers elect a board of directors who oversees the operation of company. Fund from remain in paying claims, and operating costs may be distributed to the policy owners as dividends. In a mutual insurance company, dividends are considered a refund of overpaid premiums and are not taxable. Mutual policies are referred to as participating policies because the policy owner participates in the operating results of the company. Mutual companies are referred to as participating par companies because they are par policies. Mutual insurers, policy holders, policy owners. Mutual insurers owned by policy holders. Dividends is not guaranteed. Dividends is paid to policy holders. Dividends are not taxable. Consider refunds of premiums issued participating policies. Fraternal benefit societies. Fraternal benefit societies exist in the benefit of their members and often offer insurance as one of their benefits. Through its members, fraternals also provide social activities and usually engage in charitable and benevolent causes. Fraternals are organized under a lodge system and receive some income tax advantages. The organizations are typically based on common religion or ethnic group and provide many services, including insurance to their members. Fraternal policies are called certificates, and members who have insurances are called certificate holders. A distinctive feature of fraternal insurance is that certificate holders may be assessed additional charges if premiums are not sufficient to pay claims during a given period. Policies with this feature are referred to as open contracts. Fraternal benefits societies. Benefits of members. Fraternal benefit societies provides insurance and other benefits. Must be a member to get the benefit. Reciprocal insurers. Reciprocal insurers are unincorporated groups of people that agree to insure and issue each losses under a contract. The member of the reciprocal group are known as subscribers. Each subscriber has an account though which premium are paid and earn interest and track. If any subscriber suffers a loss covered by the reciprocal insurance agreement, each subscriber account is assessed as an equal amount to pay the claim. Administrative, underwriting, sales, promotions, and claims handling for the reciprocal insurance and handled by an attorney in fact. The attorney in fact is often controlled and overseen by the advisor committee of subscribers. Reciprocal insurers. Subscribers. Reciprocal insurers. Unincorporated members are assessed if a loss occurs to any member of the group. Managed by the attorney in fact. Lloyd's Association. Lloyd's Association, name in reference to the famous underwriting group Lloyd's of London, are not insurance companies. Rather, they are a hub of exchanges of information among members, underwriters, whose actually transacts in business of insurance. Members are individually liable for responsible for the contracts of insurance into which they enter. Over the years, Lloyd's Association have insurance on risks, unusual risks such as hole in one context, the body parts of athletes and the hair and the feet of celebrities. Most Lloyd's associations need to be sold by surplus lines intermediates because they are only licensed in a few states. Lloyd's Association. Lloyd's Association. Insurance provided by individual underwriters, not companies. Insurance, unusual risks, hole in one contest, athletes' arms, celebrity hair. Risk retention groups. Risk retention groups is a fair insurer formed for the purpose of providing liability insurance for its policyholders. The policyholders must be members of the same type of business. Risk retention groups are regulated by the state that the headquarters and can operate in the other states as well. Risk retention groups. Liability insurers for policyholders. Risk retention groups. Liability insurance companies created for policyholders from the same industry. Example, a car dealer's risk retention group in which one only a car dealer can be a policy holder. Risk groups, purchase groups, similar to retention groups. Risk purchase groups are formed to sole purpose of attaining liability insurance for its members. However, unlike risk retention groups, risk purchase groups are not insured themselves. They are not regulated as such. They only purchase insurance on behalf of their members. Risk purchasing groups were authorized by the same federal law that allowed for the formation of risk retention groups. Risk purchase groups, not the insurance company. Risk purchase groups, a group of business formed the same industry that joined together to buy liability insurance from an insurance company. Self-insure. Self-insure. It is means of retaining rather than risking risk, transferring risk. Businesses may develop a formal program for self-insuring all of a portion of certain risks. The business sets aside reserve funds to cover losses in advance, and if even have a claim, a system like the insurance company, a company that has a savings account to pay claims if an employee gets hurt, is self-insured. Self-insures retention. Self-insurance, a business that pays its own claims, reserves funds to cover losses, retains risk rather than transfers. Classifications of insurers: private versus government insurers. Insurance companies may be privately owned, operated by state, or operated by federal government. The government can step into to provide insurance that is not ordinarily available. From private insurance, the federal government provides war risk insurance, nuclear energy liability insurance, flood insurance, and federal court insurance. At the state level, the government is involved in providing unemployment insurance and may provide workers' compensations benefits through state funds. Private versus government. The federal government provides insurance, war risk insurance, nuclear energy insurance, flood insurance, federal crop insurance, unemployment insurance at state level, workers' compensation at state level, domestic, foreign, and alien insurance. Depending on where an insurance is headquartered, it is classified to be domestic, foreign, or alien. In the home state, the state in which the insurer is formed, chartered, and incorporated, and usually headquartered in insurance, is referred to a domestic. An insured home state is also called the state of domicile. In another state, the U.S. territory, or insured is referred as foreign. From example, the insurer that is domiciled in Texas would be a foreign company to the residents of Oklahoma or any other state in the U.S. territory besides Texas. An insurer formed under the laws of any country other than the United States and its territories is considered an alien insurer to the citizens of the United States or any U.S. territories such as Puerto Rico. Any U.S. territories such as Puerto Rico or Guam, an insurance based in any other country is an alien insurer. The following slides provides a visual treatment of these classifications: domestic, foreign, and alien insurers. Insurance companies: location, domestic, the state where the company is incorporated. Foreign, company is incorporated in another state or U.S. territory. Alien, company is incorporated in another country. Authorized versus unauthorized insurers. State issues requires companies to have license to sell insurance in the state. The license is called Certificate of Authority. When a company is licensed, it is called admitted or authorized to do business, you see. Some states allow companies to sell insurance to certain types of risk called surplus lines without having to have a license. The companies are then called non-admitted, unauthorized, or non-approved. Certificate of Authority, state license for the insurance company. Authorized, authorized versus unauthorized. Insurance company admitted. Certificate of Authority, sale, place, and services. Most insurance contracts. Unauthorized. Insurance company, non-admitted. No Certificate of Authority, sell surplus lines insurance products. surplus lines insurers. Sometimes an individual or a business will have a exceptional large or specialized risk that no authorized insurers can or will cover. In such cases, insurers may be obtained to an unauthorized, non-admitted insurer. On the surplus lines basis, surplus lines insurers is placed with the non-admitted carrier by the surplus lines agents or brokers. Surplus lines insurers can only be transacted according to the certain rules govern that type of business. The example states keeps lists and acceptable surplus lines insured and particular risks that are covered, and also rules that do not allow surplus lines insurance to be purchased only to get a cheaper rate when insurance is available from the authorized insurer. Surplus lines insurance is also called excessive and surplus lines because in some cases a limited amount of coverage is available from the authorized insurer, and only the excessive is obtained through the surplus lines insurer. Games, casinos, entertainment, mining, skyscrapers, all are examples of exposures that might require surplus lines insurance. Surplus lines insurance. Surplus lines insurance sold by unauthorized, non-admitted insurers. If on the state-approved list of surplus insurers, can only be sold to certain high-risk insurers, cannot be sold for a cheaper rate than licensed admitted insurers. Financial rating of insurers. Insurances may also be classified according to their financial strength. There are several independent ratings like this. Agencies and evaluate various factors such as the insurance laws, experience, reserves, investment, performance, management, and operating expenses. They assign engineering insured rate based on that analysis. The organization that rates insurers include AM Best Inc., Standard & Poor's Insurance Rating Service, Moody's Investors Services, Duff & Phelps Credit Rating Company, and Wise Rating. These firms do not all rate every company, and each firm has a different criteria on which companies are evaluated, which firms are also differentiated in rating its scale. Financial ratings of financial ratings insurance. Financial strength rating, a report card of the company. Quick quiz. Here we go. Oh boy. An insurance company incorporated in Wisconsin and conducted business in Wisconsin is known as a domestic company. What kind of company are they considered if they do business in Minnesota? Form. All of the following statements about the stocks insurance companies are true, except all of the following statements about a stock insurance company are true, except a stock company pays dividends to stockholders are true, except a stock company pays dividends to its stockholders. That's true. A stock company is a participating company. A stock company is a non-participating company. A stock company has shareholders. So it's B or C. You have to come back on that one. What do insurance companies use to help predict how many losses will occur in a group or class of individuals? What do insurance companies use to help predict how many losses will occur in a group of class individuals? What do insurance companies use to predict how many losses will occur? The law of large numbers, Standard & Poor's, risk retention groups, adverse selection. A, the law of large numbers. 4, States require companies to have a license to sell insurance in the state. The license is called a certificate of authority, reassurance license, producer's license, and admittance license. States require companies to have license to sell insurance in states. The license is called, and I'm thinking it's a producer's license. Certificate of authority sounds right too. So that's two I'm not 100% on. I'm guessing, I don't know. It's a producer's license, a certificate of authority, and then for all the following statements about stock insurance companies or except. Gonna go stock company is I can't remember what a participating and non-participating company is. I think if you're talking about, I don't know, I'm guessing, but I think we read something about private companies, the companies that weren't beholden to stockholders, so those have to be participating companies. So all of the following statements about stock insurance companies are true, except a stock company is a participating company. So it may be, I think it's B. And number 4, state requires, I don't know what the name of the license is. I'm pretty sure it varies per state, but I'm gonna probably go with a producer's license, which gives you a certificate of authority to sell your license in the state. I'll put the answers in the description. My mouth is dry. Somehow I gotta figure out how to take a drink of water in between these lessons. Anyway. King can booth, 100 proof, always bringing you nothing but the truth.